Senstar Technologies Q2 2026 lacked a formal Wall Street consensus to beat or miss, but management claims the results matched their internal plans. Revenue hit $10.45 million, which is up 8.2% year over year, and EPS came in at 2 cents, marking a solid return to profitability.
Yeah, and as for guidance, they provided no formal short-term figures, but their internal targets project $36.37 million for fiscal 26 revenue. The stock reaction, though, shares actually dropped 3.35% to $1.73 on light volume, so they're hovering right near their 52-week lows.
Okay, let's unpack this. I mean, imagine doubling sales of your most exciting new technology, returning to profitability, executing your business plan perfectly, and then, watching your stock just drop.
Right, it's definitely a tough pill to swallow.
Exactly. So today's deep dive pulls directly from Senstar's Q2 earnings call transcripts and their press releases to give you, the retail investor, a really clear picture of what is driving these numbers. Because we are looking at a company caught in a massive transition right now.
Yeah, we really are.
Combined LiDAR sales nearly doubled year over year. They now make up a full 20% of global sales. But, hold on, they just acquired Blickfield. So is this just bond growth, or is there an actual organic catalyst here?
Well, what's fascinating here is that it's a mix. The organic side is surprisingly strong when you actually look at the geography. I mean, APAC revenue surged 93%.
Wow, 93.
Yeah, and EMEA grew 14%. A massive chunk of that was driven by heavy new demand from utilities and data centers that are upgrading their physical security.
Okay, that makes sense.
But regarding Blickfeld, the integration itself is the real story here. The unit is integrating so efficiently that it actually posted positive EBITDA this quarter.
Wait, already?
Yeah. Hitting profitability that quickly means the acquisition is already paying for its own operations, which is, incredibly rare for a fresh buyout.
Right, so they essentially drained their savings account to build this state-of-the-art LiDAR extension on the house. It looks great, it's adding value, and it's already functional. But if that's the case, a 3.35% stock drop feels like an overreaction. Here's where it gets really interesting. If LiDAR is the shiny new engine pulling the train, what's dragging the caboose? Why did the stock drop?
So the crack is in their core legacy market, and it's putting a ticking clock on their balance sheet. U.S. revenue actually fell 14%.
Ouch.
Yeah. Senstar is highly dependent on the corrections market. So think federal prisons, high-security government facilities.
Right.
And those massive contracts are still delayed by the residual bureaucratic effects of the late 2025 federal government shutdown.
Oh, I see. So they haven't lost market share to competitors. They're just waiting on a delayed paycheck from the U.S. government to basically pay for daily groceries.
Precisely. The pipeline is there, but the ink just isn't dry. And while they wait, their gross margins compressed year over year down to 64.2%.
Gotcha.
But the metric that really spooked the market is their liquidity. Cash plummeted 64%, dropping from $22.5 million down to just $8 million.
$8 million. I mean, that is a massive drop for a company targeting over $36 million in annual revenue. Did he just burn through it all to keep the lights on?
Well, no, context is essential here. That cash was primarily used to fund the Blickfield purchase outright.
Okay.
So they traded their cash cushion for growth capacity, which leaves the company completely debt-free. But, it removes almost all their margin for error. They are now in a literal race against time to complete this pivot before that $8 million runs out.
So what does this all mean? Like, how do they survive the squeeze for the rest of the year?
Management is heavily banking on a U.S. corrections recovery in the second half of 2026 to unlock that stalled cash flow. Concurrently, they are prepping for the launches of 2 major products, their embedded fiber trench and the Symphony workflow engine.
And to be clear on the mechanism here, Symphony isn't just another piece of hardware. It's a workflow engine designed to shift their business model towards software subscriptions, right?
Yes.
Because that recurring revenue is exactly how you fix those compressing gross margins. Moving away from fighting for one-off hardware deals to stacking reliable software revenue.
Right. It's a higher margin, much stickier revenue stream. But it takes time to roll out and actually achieve mass adoption, and time is the one thing their balance sheet is short on right now.
It's the ultimate tension. I mean, they've bought this powerful new technology with cash, but now they're waiting on the government to clear checks just to bridge the gap.
Yeah, that's exactly where they are.
Which leaves you with a final question to ponder. With cash reserves down to just $8 million, Will Senstar's plan to pursue Canadian and German R&D grants be enough to bridge the cash burn gap before their new subscription products achieve mass adoption?
That is the defining test of their financial runway right now.
Make sure to follow the show for daily earnings coverage to see how this plays out.